Hey YouTube, this is Steven with On My Way to Fire, a channel about early retirement and all things investing. And in today's video, I want to talk about the S&P 500 and give some market perspective about what's going on. All right, so as of today's market, Wednesday, June 24th, the S&P is at 73.88, and we're down about 3% from the high for the year, which was 76.09 on June 2nd. So it's been an incredible rally for the year. We've pulled back just a small amount, and a lot of that's related to the AI and tech companies having a little bit of a sell-off ever since the SpaceX IPO. And the excuse made, by the media and how they drive their narrative was that investors and hedge fund companies are raising money by selling their winners at massive gains, trying to get into the SpaceX IPO. And so when SpaceX came out, the IPO price was $135, but that's if you got the actual IPO directly, okay? If you were buying it on the market, the first trade actually went through right around $150. So it did hit a high of 225, but as of today's video, the price is somewhere around 156. So it's pulled back quite a bit from the high, but still above the IPO price. And so, the narrative that we're hearing is, the market liquidity dried up a little bit for some of these bigger companies to get in on the SpaceX action. So it'll be interesting to see what happens with that. There's also talk about the yen carry trade, and that's where hedge fund companies borrow money in Japan because their interest rate is a lot lower by somewhere around 2%. And when the dollar strengthens against the yen, that margin that they're making, that arbitrage, it lessens because they have to pay more in dollars to convert back to pay off that yen. So again, that also leads to forced selling and taking profits. So, that narrative's been out for about a year and a half or so. It'll be interesting to see if this is something that's continued to be said over and over again. But, just to give perspective about what's going on with the S&P 500, only being down 3% from the high is actually pretty stable and somewhat comforting for what I'm seeing because, generally in a sell-off, you would see a lot of companies at once dropping, and I'm not really seeing that. It's really related to the tech and focused in that sector. And so for one example, NVIDIA hit a 52-week high on May 14th at $236. And it's been trending downward the last few weeks, and it was around 220, but it actually broke 200. And today is at 199.58 at the time of this video. So the way I look at it for all this stuff is it's a buying opportunity to add more to some of the things that I like. I do like NVIDIA. And one of my goals recently was to start purchasing some partial shares. So I put 40 bucks on it today just to get in with whatever little cash I had left in my taxable brokerage account, because my goal is to build shares over time, just averaging in. And so I've got to wait because most of my dividends aren't really coming in until Friday, and then at the end of next week for June 30th, that's where a lot of my quarterly dividend payers and my monthly payers will all drop on the same day. So I got to be patient here and look for opportunity. And one good thing that's been happening in the last couple of weeks is a lot of my REIT and REIT funds have been doing great. They are at 52-week highs, which is pretty unbelievable because the talk in the market has all been about interest rates being stuck or possibly rate hikes, yet these REITs are going up. So it's pretty crazy. And, the way I see this is just having diversification into different asset classes, technology, utilities, banking, closed-end funds for income, preferred funds, stuff like that. And then you have, REITs. And sometimes REITs are related a lot to the banking and lending companies. And for them to perform better, it might be company specific. But again, if it's a fund, that has many companies in it. So, it kind of leaves me wondering, and back to square one with all this with diversification, that, sometimes the market is not logical in the way that you see it, in the way that the pricing changes. So it's been a real eye-opener, and I'm thankful that I had money in different asset classes that I could sell at a 52-week high, and take gains between 30 and 45%. So I'm really happy about that. And what I'm doing is I'm rotating into other stuff that's down right now. But I'm not going too crazy with it, and I'm not selling everything all at once from some of these REITs. I'm waiting and just selling a little bit, maybe 4 to 5 shares at a time, and then, raising that cash, waiting for more dividends to drop, and then put money in stuff that's down. So that's the way I do it. And that way I don't get too far ahead of myself with a large purchase in thousands of dollars. I'm just buying a few shares at a time if it's a lower cost stock. And then on a company like NVIDIA, a share trades for, almost $200. So the best I can do is just keep putting $20 to $50 up to it, here and there, and just keep building a position. So that's the way I look at it. Then, as far as SpaceX, that's something I'm going to be watching, but I'm not going to be buying it. And, I want to see if it goes under $100 and see how it performs at that point. Since it's a publicly traded company, they're going to have to do earnings reports and, be much more scrutinized in the public market. But I'm going to do a video on IPOs, and I'm going to cover what's happened since they've opened and how that's all going in another video. So look forward to seeing that. But another interesting fact that I found out recently was that the S&P 500 has never made a high in the month of June for the year. And so seeing that the high so far for this year was on 6.2, if we didn't have another high for the year, this would be the first time ever since 1950 that that's happened. So what that's trying to say is by the end of the year, we'll likely be higher, but we got to get through all the noise and turbulence of what the market's doing right now. So anyway, I see this as a buying opportunity for stuff that you didn't really get in on, between February and March. Having a bit of a pullback, it's not major. I'm not panicking, and I'm keeping all my allocations in my 401k the way they are and just let it play out. One of the big changes I made, though, about a month and a half ago, was I increased my cash position to be purchasing stable value fund and a short-term bond at a higher percentage. So I'm somewhere around 15% right now going to cash within the 100% of how I allocate my 401k purchases every other week. So it'll be interesting to see how that plays out. Just let that money build up. And then if we do have a real crash, I'll have a source of income to purchase with. But for now, I'm going to keep all my other allocations more or less the same, slightly reduced from where they were, back in February through April. I want to be a little bit more mindful of taking profits in my other personal accounts and trading, from a position of strength. And I think that's something that I've learned over time, just being more patient in the market. So, we'll see how all of this plays out. But as it stands now, down only 3% from the yearly high. A lot of this turbulence will pass, but a lot of it's dependent on earnings and what companies are coming up and how, companies like Micron are used as a proxy more or less for how AI is doing in general. So we're going to have more IPOs coming out on the market, and there'll be plenty more news this year, and I'm sure it's going to be an interesting ride. So with all that said, thanks for stopping by. If you got anything out of this video, please give me a like and subscribe, and we'll see you in the next video. Thanks.